Welcome to another accounting e-learning video. Today we will learn about how to record journal entries in the diary of the business. You have learned how to analyze the effects of transactions in chapter 3. Now you will make use of that analysis to proceed on to recording the transactions in the journals. In order to do so, you will need to apply the debit and credit rule of recording transactions in the journals. You need to note that we do not record in the journals using addition or subtraction. Instead, we have our own accounting language known as the debits or credits, which you will see in the next slide. The terms debit and credit strictly mean left and right. From the expanded accounting equation, we have assets equals to liabilities plus income plus capital minus expense minus drawings. We can rearrange the elements to get assets plus drawings plus expenses equal to liability plus income plus capital. The debit and credit rule is simply assigning an increment in the asset, drawing, and expense account as debits to the account, while an increase in the liability, income, and capital account is assigned a credit to those accounts. Simply put, after you have analyzed your transactions, you would need to translate that increase or decrease to debits or credits. This is nothing more than just translating the mathematical language of pluses or minuses to debits or credits. This table is an important one and you will need to memorize it in order to record transactions in the journals. We will be looking at some examples on how we can apply this rule to recording. To help you record the transactions in the journals, let's look at some ways to enable us to do so. We can make use of a UPAC method to help us prepare journal entries. The steps are as follows. Firstly, we will identify the accounts affected in the transaction. Next, we will analyze whether those accounts increase or decrease. Once we have identified whether the accounts have increased or decreased, we would apply the debit and credit rule using the ADE LIC table that you were shown earlier. Finally, we would prepare the journal entry by recording our analysis in a particular format. Last but not least, we need to record or remember to follow the rules when we are recording the transactions. We would now learn how to record transaction in the journal. To enable us to record the transactions effectively, we will make use of the UPAC strategy to do so. First step, we identify the accounts affected in the transaction. For contribution, the capital account is affected. Where there's van involved, we will record it in the motor vehicles account. Step 2, we determine whether the accounts increase or decreases. When the owner contributes an item to the business, the capital account increases. To translate the increase in the capital account to our accounting language, we would make use of the ADE LIC table. An increase in capital account means that we need to credit the account. Next, let's look at the effect on the motor vehicles account. When the owner contributes motor vehicle account increases. Motor vehicle is an asset, and when asset increases, we would need to debit the account. Step 4. We are going to prepare journal entry. To prepare journal entries, we would need to record the debit entry first. So we would record the motor vehicles account as close as possible to the line. Next, we will record a credit entry to the capital account. Note where the capital account is recorded. There is a spacing from the line on the left. One look at it and we will be able to tell that capital account is credited because it is placed at some space away from the motor vehicle account. We would then place the amounts and we would check that we have not violated any rules of recording. First, check at least 2 accounts are affected. At least one account is debited and at least one account is credited. Check number 2, the total debits is equal to the total credits. Looking at another example, we would still apply the UPEC strategy to prepare our journal. Step 1, identify the accounts affected. We look at keywords like withdrew, which indicates that there's drawings affected. We also have the furniture account, which is affected. Step 2, we determine whether the accounts increase or decrease. The drawings account took place, which means that drawing has occurred. And when drawing occurs, the account increases. Since the drawing account has increased, making use of our ADE LIC table, we would need to debit the drawings account. Looking at the furniture account, when the furniture account or when the owner withdrew furniture, the furniture account decreases. Furniture is an asset, and when asset decrease, we would need to credit the account. Step 4, we will prepare the journal entry. We would record the debit entry first, followed by the credit entry. We would then place the amount and check that the transaction has an equal number of debits and credits. Let's look at another example. Again, we will make use of the UPEC strategy to prepare journal entries. Step 1, identify the accounts affected. Step 2, we determine whether the accounts increase or decrease. Since the business purchased equipment, the business will have more equipment. Equipment is an asset, and to increase an asset, we would need to debit the account. The business paid cash. Therefore, the business will have less cash in operations. Cash in hand account will decrease. Cash in hand account is an asset, and when asset decreases, we will need to credit that cash in hand account. Step 4, prepare the journal entry, placing the debit entry first, followed by the credit entry. We will next place the amounts and check that we have not violated the 2 rules of recording journal entry. first check is there are at least two accounts affected. One of the accounts must be debited and at least one of the accounts must be credited. Check 2. The total debits of $8,000 must equal to the total credit of $8,000. The next transaction, again making use of our UPEC strategy. Step 1. Identify the accounts affected. We have identified goods, which would be recorded in the inventory account, and the business bought it on credit, which means that the other account affected is an owing to ABC, which is just trade payables ABC. Step 2. Determine whether the accounts increase or decreases. When the business buys goods, inventory account increases. Inventory is an asset. To increase an asset, we would debit it. Trade payables is an owings account. When the business buys goods on credit, the business owes the supplier more. Therefore, trade payable accounts increases. Trade payables is a liability, and when liability increases, we would need to credit the account. Step 4. Prepare the journal entry by recording the debit entry first, followed by the credit entry. We would then place the amount in the respective columns. Finally, we would do a check to ensure that we have not violated the rules of recording journal entries. The next transaction is a purchase returns of goods, and there's a refund by check. Again, making use of the UPEC strategy, we will identify the accounts affected. Next, we will determine the effect on the accounts. When there's purchase returns of goods, the business has lesser goods. Therefore, inventory decreases. Inventory is an asset, and when asset decreases, we will credit the account. When the business returns the goods, it is refunded with a check. Therefore, the business will have more money in the bank account. Cash at bank account will increase. To denote an increase in an asset account, we would need to debit that account. Step 4. Prepare the journal entry by recording the debit entry first, followed by the credit entry. Finally, we would check that we have not violated any rules of recording. As you get more familiar with the steps, you will be faster in generating the journal entries. Nevertheless, we will still go through the necessary steps to prepare the journal entries. Purchase returns. The business has lesser goods. Asset decreases, we will credit the account. On the other hand, when the business returns goods to the supplier previously bought on credit, the business will owe the supplier lesser amount. Liability decreases, we would debit that account. Preparing the journal entry, we would then check that we have not violated the rules of recording. To prepare this journal entry, again we will look at the UPEC strategy to do so. Step 1, we identify the accounts affected by looking at certain keywords in the transaction. We can see that there's cash. We can see there's a credit supplier MNO. Next, we'll determine the effects on the accounts. When the business pays cash, it will have lesser physical cash with it. Cash in hand account decreases. Cash in hand account is an asset. When asset decreases, we will credit the account. When the business pays cash to the supplier, previously it has bought these goods on credit terms, and now the business will owe the supplier lesser money. When the business owe the supplier lesser, the trade payable accounts decreases. Trade payables is a liability, and when liability decreases, we will debit the account. Step 4, we prepare the journal entry by recording the debit entry first, followed by the credit entry. Finally, we will check that we have not violated any rules of recording. That's the end of the first part of recording. There are many more transactions out there, but if you use the UPEC strategy to prepare journal entries, it will get easier over time. Please review the materials if needed. Thank you for watching.